Active management means picking stocks. It means picking your stocks that you want to put into a carefully constructed portfolio rather than owning the whole index just to have market exposure. Because believe it or not, in that index, there are some things that you might not want to own. We think that with fundamental research, following a proven and consistently applied process, we can find stocks that are good companies, that have strong market positions, that are well run, that are appropriately levered, and are undervalued. And if you put those together in a portfolio, you can do better than owning the entire market or the entire index. Because as I said earlier, there are some things in there that you wouldn't want to own. Companies that are not run well, companies that have too much debt, or might have some market dynamics that are working against them. One thing that a lot of investors don't understand about the index is that about a third of the companies in that index lose money. So if you own the whole index, you are owning a lot of companies that aren't performing well, that are losing money or burning cash. And so risk management in an active portfolio is all about knowing what you own, knowing your risks, and then putting together a portfolio that looks for companies that not only have great market positions, but they also are attractively valued. There are certain times when passive can do very well. When you're in a market where earnings are growing and multiples are expanding, you can own the index and you can do pretty well. But over time, you got to question whether that's the right approach. Because over time, those companies that are losing money, those poor quality companies, can hurt you. And also, over time, you can look at the index, and the index can begin to trade at some pretty lofty levels. I think it's important for investors to understand what they are investing in. And I think it's important for them to understand what the real valuations are of the products that they're investing in. And then think about whether that's what they really want to own. To not be lulled into a sense of security that just because there are 2,000 stocks held in the index, that gives them diversification and therefore lower risk. So for some clients, it may make sense to have some portion of their assets invested in a passive vehicle and another portion of their assets invested in a highly active vehicle. Good active managers have been at it for a while. They're not just born yesterday. They have a proven track record. They have a proven philosophy and process that has been consistently applied by an individual or a team, and that team has been through multiple market cycles. They've been through good times when it looks like everybody is brilliant, and they've been through difficult times when it's harder to find the right path forward. That's an opportunity to learn, and that's an opportunity to get better. So I'd say look for managers that have been at it and that have been consistent with their methodology and their practice.